On June 5th last month, the Bank of Canada made a big splash by cutting the interest rates by 0.25%, bringing the benchmark rate down to 4.75%. This made Canada the first G7 country to cut interest rates after the pandemic's massive monetary easing. A lot of people thought that this would cause the housing market to take off again. But just as I feared before, the market didn't boom. Instead, it continued the downward trend from May and kept falling. I even posted on social media saying that the rate cut wasn't really that important because the market has already predicted it. What really matters is how the market reacts. Some clients of mine saw the posting and weren't really happy about it. But anyways, besides the average price continuing to drop, transaction volumes also showed no improvement, down about 17.39% compared to the June last year. So let's take a closer look at the recent transaction volume and the new listings from the Windsor Real Estate Board. The board amends its data every year, so just focus on the trends, not get caught up in the small differences in the numbers. From the charts, you can see that this year, every month's transaction volume is down compared to last year, so except for the January and February. And the declines seem to even get bigger. On the other hand, the number of new listings have been increasing compared to last year. More sellers are choosing to list their homes for sale. It wasn't until the rate cut was announced in June that the new listings began to decline, as some sellers decided to hold on to their homes and see if the rate cut would affect the market trend. Looking further back at the trend in transaction volumes, we can see that after the peak price in March 2022, many sellers rushed to list their homes while the market was still uncertain, hoping to sell before the downward trend was firmly established. As a result, the number of listings surged by nearly 36% by June. In the second half of the year, the monthly transaction volume kept increasing and then took a sharp dive, even dropping by half. Following the continued decline in transaction volumes and average prices, the number of new listings also fell sharply, indicating that the remaining sellers were still quite confident, thinking that the prices would recover after a short-term period. This mentality started to change slowly in 2023. In the first half of 2023, transaction volumes and new listings both declined. While the average price rose from around $500,000 at the beginning of the year to nearly $600,000 in May, many people thought the market was indeed recovering. So from June onwards until the end of the year, the number of new listings steadily increased and the transaction volumes even rose in the same time. Many buyers also thought that it might be a good time to enter the market. Of course, one main reason for the apparent recovery in the data was that the previous year's data was really poor. However, the strange data from December 2023 seems to have set the stage for 2024 housing market. Changes began in 2024 March, which is typically a busy season, but the long winter seemed to have cooled down the things. After steady increases in the first 2 months, both new listings and the transaction volumes dropped in March. It was also in March that the Stats Canada announced that the employment rate had risen above 6% for the first time since 2022. Inflation data also started to climb from 2.8% in February to 2.9% in March. The simultaneous increase in both unemployment rate and inflation made some people worry that Canada's economy might be entering into a stagflation, which is even worse than the inflation alone. For those who are interested, you can Google stagflation. In short, it's a situation where stubborn inflation goes even worse, leading to rising prices and falling wages. So from March onwards, more and more people start to worry about a long-term economic downturn in Canada. Accompanied by these concerns, transaction volumes began to plummet from March, while the number of new listings slightly increased. Let's take another look at the historical inventory and MOI for the Windsor housing market in the past 10 years. MOI represents the time needed to completely clear the current housing inventory. And generally, 5 to 6 months represents the balance between the buyers and the sellers. More than 5 to 6 months indicate a buyer's market. So even now, many sellers think that the market is still in their favor. If they don't change their perception, they might find themselves stuck for a long time, unable to sell until the next cycle comes in. So if your investment property has positive cash flow, you're likely to be able to weather this tough period. This is why I always emphasize the importance of cash flow. For those who still don't understand the difference between assets and liabilities, especially those with a lot of leverage, this period will be particularly difficult. I hope everyone can successfully get through this challenging time, and thanks for watching. I will see you next time.